behavior, please. No typing, no banging desks. Okay, here we go. Hello, friends. Welcome back to another episode of Plan First Wealth and Friends. This is a monthly show where James Boyle and myself, Richard Taylor, get together with our fellow professional in the expat space, Simon Misiewicz, for our regular monthly installment of our live Q&A. Now, James and I are US-UK cross-border financial planners, while Simon is a US-UK cross-border tax advisor. And each month, we pick a topic from the 12-part technical series on our website, which is available to you at www.planfirstwealth.com. And we dissect and discuss it for the benefit of British expatriates living in America. Now, before we start, allow me to give you something to chew on. It is my strongly held conviction that if any British expatriate with income and means is missing any of the following pieces: number one, a US-UK cross-border tax advisor; number two, a US-UK cross-border financial planner; and critically, that these two people or companies are speaking to each other and communicating about you. If any of those are missing, I am positive you are missing out on opportunities that are available to you, and or there are landmines lurking in your affairs. This is my strongly held conviction based on nearly a decade working in this space. Without all three of these components, you or the professional team you have around you most likely simply don't have the experience or knowledge to know what to look out for specific to Brits in America. If this resonates with you, please follow us on LinkedIn, subscribe to my podcast, join our newsletter list, or best of all, reach out for a conversation about how we can help you make the most of your opportunity. Okay, before we get into the good stuff, I need to ask James to read a short disclaimer. James.
Plan First Wealth is a registered investment advisor. The information presented today is for educational purposes only. Plan First Wealth does not provide any tax and/or legal advice and strongly recommends that clients seek their own advice in these areas. Part of the reason we do this. For anyone watching live on our social media, whether that's YouTube, LinkedIn, Facebook, or elsewhere, please feel free to comment as we go here. We'll be happy to cut out and answer any questions you have. If you're listening to the podcast, feel free to reach out to us otherwise on our website, planfirstwealth.com, or elsewhere.
Richard, okay. Thank you. Simon, do you want to introduce yourself? I think I've just dominated the airwaves.
Not at all. It is your space to dominate. Hi, everyone. My name is Simon Misiewicz from Optimize Accountants. I am indeed a dual qualified and licensed practitioner of tax in both the United States and United Kingdom. And I'm here to help you build your wealth through Plan First Wealth whilst reducing your tax liabilities and remain compliant.
That's it, right? Let's just stop there. That's what it's all about. Build your wealth, pay less tax, be compliant, less risk. I mean, that's it in a nutshell. Right, so today, folks, on the docket is the second installment of our technical series, and it is US retirement accounts. Obviously, with British expats in America in mind. So we're going to talk about that. We're going to talk about our blog posts and go through that. But before we do, someone has just posted something that I've got to call out here. Simon, thank you, has said expats have got their votes back. Previously lost it because of the now gone 15-year rule. This is news to me. Do we mean Brits have got? Because I thought it was I've lost my vote, but I thought it was less than 15 years. So I'm unsure what it's referring to, but I'm very intrigued because I would like to vote again. So in the UK, that is, I can obviously vote in the US now. So we're going to investigate that, Simon. I don't actually know what you're referring to, but I'm going to find out. But feel free to share more if you want. Okay, guys. While we wait for incoming breaking news, let's start with US retirement accounts. So the reason this blog's up there, our first blog and the topic of our last Q&A was UK pensions as a US person. So this is actually something, UK pensions is there. In many ways, it probably shouldn't be the first blog, because what happens is people move to the US, in my experience, people move to the US, neglect their UK pensions for 20 years because they don't know what to do with it, and then get in touch with us and wish they'd done something 20 years ago. Right. Because what they're doing in the interim 20 years is focusing on their US system. So they have to get to grips with an entire new system. Bear in mind, most regular folk don't get to grips with the UK system because they don't need, because it's all this stuff there's lots of moving parts and it can sometimes be overcomplicated. So they move to the US and they have a whole new system to get used to, full of numbers like 401k and 403b and 457a or whatever it is, and it's kind of overwhelming. So we wrote a blog to address that. In many ways, it's the most important blog, I think, for newly arrived expats. So today we're going to talk about that. I'm just going to stop there for a second. Anyone jump in? Anything to say, or shall I just keep waffling on?
Carry on.
The only thing that for people who attended our webinar recently, one of the takeaways was that you don't need to be an expert, right? And if you find yourself not an expert, don't kick yourself. Very common position to be in, but it does help to have a handle on the vehicles and tools available to you in this new landscape, as Richard mentioned.
Yeah. Well, look. No, please go on, Simon.
No, I was just going to interject because you mentioned actually someone that's in the United States that just happens to forget that they have pensions. If they've forgotten that they have pensions, it's plausible that they've also forgotten to report those pensions to the IRS.
Oh, yeah. Oh, yeah. They've not necessarily forgotten them, honestly. It's more that they've
but
moved here and then they've thought...
They've forgotten about one pension.
Oh, well, that, yes, yeah. I mean, look, I'm like a broken record on this point. I know I am, but everyone moves here. It's not that they forget about the pensions, well, I'm sure some people do, but it's just that they move here having not done anything. They get here and then no one can tell them what to do. The providers in the UK are no longer interested in talking to them. So these pensions just get stuck in limbo. So they might be being reported, although I bet you they're not being reported everywhere they should be, in a lot of cases. But they just get the opportunity cost. They just get neglected, and my bet is most people are also in non-compliance because freaking everyone is. And the overriding theme of when I talk to expats is everyone moves to America for opportunity. I'm sure there are exceptions, right? I'm sure people move here for marriage and other stuff, but most people we speak to move here for opportunity, building wealth, income, career, all that good stuff. And a big part of that is amassing sizable retirement accounts in the US through employer and employee contributions and other means, maybe Roths. So it's a really, really important pillar of wealth creation in the US. So we want to make sure people understand it. Now I'm going to start with the most obvious one because I'm going to start with the 401k. Also, there are similar pensions to the 401k. There's the 403b. There's the 457b. Now, 457bs are if you work for the state or local government. I think I very rarely come across them. 403bs I come across more regularly. They're for non-profits. My wife has one, but more that's when people have moved here and started working. The 401k is the most common because it's private employers, but also it's the most common, I think, because our clients tend to move over here with a company. So they go straight into a 401k or straight have the option for a 401k. And it's just it's the US equivalent of a GPP, a group personal pension. It's a retirement account that employer and employee can contribute to. The employer doesn't always contribute to it, and the employee doesn't have to contribute to it. But usually there's an employer contribution, and an employee can match that and maybe even put in more, subject to certain limits. So the most common, currently the 2024 limits are personally, so an employee contribution, an employee under the age of 50 this year, 2024, can contribute $23,000 to a 401k. If you're over 50, you can contribute another $7,500. So for a total of $30,500. Your employer is obviously putting money in as well. Well, hopefully your employer is putting money in as well. And the maximum that can go in if you're under 50 in pre-tax environment is $69,000. Okay, so obviously that's $76,500 if you're above 50. So that's not an insubstantial amount of money. $70,000, $69,000 going into a pre-retirement account. That's a decent chunk of change. There's also the ability to, scheme dependent. And we see this with some of our clients. There's also the ability to put in after-tax contributions. Maybe if you're going to go above the 69,000 or the enhanced limit, if you're above 50, you can put in more than 69,000. But then the different rules apply. So it's worth. We're not going to go into that in great deal now. It is an option in some schemes, not all schemes. Then there are different strategies you might want to consider to get that money out. You can just withdraw it. You might want to consider a Roth conversion. But 401k is the account that we see most commonly. Employer-sponsored accounts. There's almost certainly free money on the table from employer contributions. They're really, they're, like I said, they're a pillar of building wealth here in the US. Anyone add anything to that?
The only thing that's to mention maybe is that, our clients, like you mentioned, Richard, sent over here with a team or building out a product, high earners. If you can maximize it comfortably with your cash flow, do it. The tax incentives make it worthwhile. There's a reason they're built into the tax code to incentivize investments. And the other piece is have an understanding of what you're actually investing in, right? Because a lot of times in the States, you're left to your own devices, right? There's a menu of funds, so to speak, to choose from. So you want to understand where it's being put, have a plan in place to do that efficiently and in an optimized way. Sometimes we see clients with a massive range of 10 different holdings and no real clue why or how they got involved with them. So keep that in mind when you're making investment choices.
That's a good point. Something we see, so many people default to this lifestyling regime, right? For anyone who doesn't know, it's when you go into a fund like a Vanguard 2035 fund, and your retirement date being 2035. Let's say that's when you're 65, and in the lead up to that 2035 date, it will automatically change your investments from equities into a much lower risk and lower return fixed income. And that might be right for you. My personal opinion is that's wrong for most people. For most people, staring down the barrel of a 30, 40-year retirement, which is what we're hopefully all staring down the barrel of now. And that's a good thing for most people. Being automatically invested into low risk, low return assets could potentially devastate your plan, frankly. Hopefully it's not that extreme, but it's the potential's there. Lifestyling, in my opinion, is a very blunt instrument, and I don't think it's fit for purpose. So that's something to be aware of. Nuts and bolts. I'll just add, for anyone who doesn't know, you put money into a 401k pre-tax, so you don't get taxed on it. Your income is the taxable income is deducted for that year. It grows income tax and capital gains tax free, but then when you withdraw it, it is fully subject to income tax. So the tax rate upon withdrawal is significant. And for that reason, that's why something called required minimum distribution supply, which we'll talk about in a second, because this can catch people unawares. It's not a feature that's also replicated in the UK. It's a uniquely American feature. So we'll talk about that. But before we do, I will also add one other thing. Unlike the UK, in the UK, you are not getting your money out of a pension before you're 55. It ain't happening. And if you are unlucky enough to be able to get access to it, you're going to get hit with an almighty penalty from HMRC, 55% or something crazy. So you're just not getting it out before 55. In the US, it's different. You can access your money in a 401k or an IRA early, but there will be and the access age is 59 and a half. But there's a 10% penalty that will apply, plus any tax that's due on the withdrawal. So it is accessible, but you pay tax and you pay a penalty. There are exceptions, right? Some are 401ks let you borrow from them. You can also, I think, take money out of an IRA to purchase your first house, subject to certain limits. So these are broad strokes I'm brushing here. Okay, so there's always exceptions and nuances, but broad strokes, that's how a 401k works. So let's talk about an IRA. So an individual retirement account is, I think, more akin to anyone from the UK might be more familiar with a SIP, self-invested personal pension. And this is when, in the UK, when you leave your employer, you might have an old group personal pension, you might leave it there, or you might roll it into your SIP, self-invested personal pension. You might amalgamate it with other pensions. You have the ability to manage it. You have the ability to just have more control over it. When you get to retirement age, you have more options on how to get access to it, etc., etc. Well, an IRA is broadly the US equivalent of that, I would say, People working jobs, they contribute to their 401k or their 403b. They leave their job, and then they can leave them there. And sometimes there's good reasons to leave them there. Or if they want more control, they can roll it into an IRA, an individual retirement account. And this just means they have more options in terms of investment choice. It's governed by a different part of the Inland Revenue Code. So there are different requirements. There are some important details again in the small print, but largely it's just a retirement account that you manage. It's a safe space for you to or a convenient place for you to amalgamate your various employer schemes and maybe your other IRAs into one central retirement account bucket in the US. Same rules apply in terms of access 59.5, early access 10% penalty, Roths. Should we have a minute talking about Roths? I'm going to hand over to James for Roths because I've done too much talking, but I'm just going to say one thing about Roths. Roths are great. Certainly they sound fantastic, but also if you have a Roth, they can be magic, right? But in my personal opinion, I think Roths are overhyped and over-talked about in the US because it's such a good story. Because the benefits of it are so appealing. It's something, and so much what we do is so boring and so mundane that it's talked about a lot to get eyeballs or eardrums. So I think they're great. We have Roths. We've helped people get Roths. We've helped people convert money into Roths. There's some specific opportunities for Brits in America we'll touch on later, but I think the pudding is a bit over-egged here.
So traditional versus Roth could be a hour-long presentation in and of itself. I'll try to keep it simple. And confusing matters in the States is that you can think of Roth as a different tax treatment that can apply to the different types of accounts we've already outlined. So you could have a Roth 401k. You could have Roth contributions in a 401k with traditional contributions. You can have a traditional IRA versus a Roth IRA. At its most basic, Roths are contributed with post-tax dollars. So you don't get the tax deduction up front, but any growth and distribution, subject to certain rules and limitations within the plan, are going to be tax-free. So you fund it with post-tax dollars. It's already been taxed. 30 years down the line, 20 years down the line, whenever you start taking distributions, all that growth is now going to be distributed tax-free. The main critical factor that determines mathematically which is optimal is your tax rate now versus in retirement. If you think your tax rate now is higher than it will be in retirement, mathematically, you'd prefer traditional, right? You'd prefer pre-tax. You'd prefer to get the deduction now and pay a lower tax rate in retirement. The exact opposite is true for Roth. If you expect your tax rate now to be lower than what it will be in retirement, you make Roth contributions. For our clients, again, high earners, generally in fairly high marginal tax brackets, Roth contributions are not going to make sense because of that very reason, right? In retirement, they're going to have low income, likely, and therefore their marginal brackets will be lower. That leaves aside what Richard alluded to, the myriad of planning opportunities that are available because of Roths and how they behave. So these kind of advantages aren't particular to how the account is structured necessarily, more in how you deploy them in your own financial plan. Roth conversions, just as a baseline definition, is converting pre-tax accounts. So some of that traditional fund, right, the contributions you've made and haven't been taxed on yet, into post-tax accounts, into Roth accounts. You pay the tax upon conversion, but then in distribution, again, you get the tax-free growth, and in distribution, it's tax-free. Some really interesting, intriguing, attractive strategies there for expats, particularly if you're listening, and I know we have some judging by the comments, and you're planning or potentially could move back to the UK, or really could move back to another higher tax environment, right? Then you want to think about deploying Roth conversions in that runway 2, 4, 5, 6 years ahead of that move. There's some real significant tax savings that can come into play. again, we're talking about high level planning here. That's not specific to the account itself, but worth looking at if that's on the cards for you.
Yeah. Yeah.
No RMD loss too. Probably worth
No, yeah. So should we talk about RMDs? So one feature specific to America that we're not used to in the UK. We have we used to have something called lifetime allowance and enforced benefit crystallization event at 75, but that's up in the air or gone for the time being. But what we have here is RMDs, required minimum distributions. So this doesn't apply to Roths because they're post-tax, but most money in IRAs I imagine, is pre-tax. Okay, so the government has given up taxing you now, and in the expectation that they're going to recoup it later when you're taking withdrawals. But what happens if you never take any withdrawals because you've got wealth elsewhere? Well, the government's never going to recoup that money. So to combat that, they require you to start taking taxable distributions from your IRAs or 401ks at a certain age, and these increase over time. I might be a bit rusty here. What's the age? Is it 72?
73, isn't it now?
Yeah, I think it's increasing this year to 73. For a long time, it was 70 and a half. Bumped
Okay.
up to 72. This year, it will bump up to 73. And I think part of that Secure Act is it's going to eventually reach 75 over the next
75. Okay.
years.
So you are required to start taking contribution with distributions, withdrawals from your US retirement accounts at age 73, currently, probably rising. And these are going to be taxed. And if you don't, you are hit with penalties. And I think those penalties are 25% of what you should have taken. So significant. This is like an administrative oversight that's, I think, very easy to trip over. So RMD is very important to be aware of and plan around and build that into your projections and thinking.
You could make an argument, Richard. We talk about sort of the planning opportunities. There's an argument to be made that having different tax treatment accounts available to you on the eve of retirement or available to you in retirement. What I mean by that is traditional bucket, Roth bucket, and what we'd call a normal brokerage or taxable bucket. That's a pretty good posture to be heading into retirement because it allows you the most flexibility and planning opportunities. One of the things you mentioned, you alluded to early retirement strategies to get funds sooner than 59.5, or in other words, avoid the 10% penalty. Those kind of buckets can be used to come up with a strategy, a ladder strategy to essentially get you to that non-penalized age. And a lot of that will come down to what do you have available to you in Roth buckets? What do you have available to you in brokerage buckets? So if you find yourself, and it's not uncommon, I would say, for people who've had a career in the States 10, 15, 20 years to be approaching retirement with those different type of tax buckets available to you. Again, planning needs to be involved and incorporated, but you may find that you have more flexibility than you would have thought initially.
I think that's great advice. I think that's a great point. Yeah. Right. Before we tackle leaving the US, do we want to, James? Do you have anything to add? So we've hit the main ones, right? The standard ones, the 401k and the IRA. Right? They are the ones that 9 times out of 10. That's what we're seeing. There is a plethora of additional accounts or variations of these for self-employed people or small business owners. James, do you have anything to add to those? Just a quick synopsis.
Yeah, I'll keep it real high level. There are some very interesting strategies, again, if you're going to be self-employed or have few employees. So the big ones you'll hear about are SEP IRAs and solo 401ks. There's another one called a simple IRA you may be familiar with. That's tends to be a medium-sized company if you have a few employees, lower contribution limits. But for this in particular, I'll focus on self-employed. So either solo, literally solo with no employees, or a few employees. You'd be looking likely at a SEP IRA or a solo 401k. Both have the same overall contribution limits as a 401k, an employer 401k. So that's $69,000 with catch-up. Where it gets interesting, for example, the solo 401k, you can make contributions on both the employee side and the employer side. So you employ yourself as part of your business, you max out that 23,000 and catch up. You can also then make contributions, profit sharing contributions on top of those. So again, to Richard's point earlier, if you have a business that's generating a significant amount of income and you're looking to shelter some of that, defer some of those taxes again into retirement with a lower tax rate, you'll want to consider, you really could defer up to near 70 grand or more per year. SEP works a little bit differently. I won't get into the sort of tax calculations. Roughly speaking, it's 25% of net profits is going to be your contribution limit. So again, I would say that they can be a bit more involved to set up solo 401k in particular. You need to find a broker that will do that for you. SEPs might be a bit easier. But again, if you're going to be self-employed, leaving aside the tax treatment of how you structure the business, right? S Corp versus a C Corp, and those different options available, you'll also have to make a decision on these different types of accounts. Again, don't need to be an expert, but make sure you're at least partnering with someone who can help you navigate those options.
Actually, James, I was just about to ask you that question in terms of someone that has an S corporation because of the services, but then choose to have a C corporation because of some of the tax efficiencies you can make. Can you still use the same pensions in both the S Corp and the C corporation? It's just a simple IRA.
That's a good question. I believe you can. So I think the solo 401k and the SEP IRA will both be available to you as long as you have an EIN, basically, as long as you have a company of some sort. Simple as well. I'm not sure if there's restrictions beyond that from a tax structure point of view. Solo 401ks have become, to give you context, a lot of these came from sort of legacy accounts. There used to be something called KEO accounts way back, and qualified retirement plans, QRPs. I saw for a while SEP IRAs become dominant. Solo 401ks have become pretty competitive as well, in part because a lot of these lower cost brokerages will now build these for you at a reasonable cost. Historically, to create a 401k is fairly cost intensive to get that set up and can be expensive on an ongoing reporting basis. Solo 401ks, I think they've lowered the barrier a bit so that now they're becoming more popular.
Right.
I had a SEP IRA when I set this business up, and it's incredibly easy and cost effective to administer and set up. But yeah, solo 401ks are more involved, essentially.
Yeah.
All right. Thanks, James. That was great. Wrapping up here, let's do a quick couple of minutes on leaving the US. And that's also going to tie into a couple of these comments we've got. So, this, I'm not sure how relevant this is. Well, this is relevant. A complete guess, right? But I reckon 70 to 80% of our clients plan on staying in the US. Some will change their mind, though, and go back. Some are undecided, and some will go back. We've had clients go back. More will go back to the UK and Europe, but I'm talking about the UK here. Because once everything I keep it specific to the UK because I know more about the UK and the treaty between the two. Someone goes to Portugal, say, well, I don't know how the Portugal-US treaty or the Portugal-UK treaty is going to impact what their options are. So it's really country specific, this stuff, and we're not even the experts, but the place I know the most about, unsurprisingly, is the UK. So someone goes back to the UK. A couple of notes I've made here. First thing, much like your UK pensions have to stay in the UK, your US retirement accounts have to stay in the US, right? Whether it's 401k, IRA, you could probably move between those two, but until you withdraw these funds, until you take them out of the retirement account, they're going to stay in a qualified retirement account in the US. Okay, you can't move them into a UK pension or wherever you are. That they're separate and will remain outside of it. The other thing is, if you're going back to the UK as a US citizen, you need to be thinking about citizen-based taxation. It's not the same as moving here. When you moved here, you were a UK resident. You ceased to be a UK resident, and most UK taxes stopped. If you're going back as a UK resident, as a US citizen, the US taxes its citizens globally. It is a different kettle of fish altogether. Frankly, it's kind of a nightmare, but you're much better to be appraised of it and get your ducks in a row before you go back. If you're going back as a green card holder, you need to be familiar with the exit tax and becoming what's called a covered expatriate and try and avoid it if you can. And you also need to be aware that if you are a covered expatriate, if you are subject to the exit tax, 401k and an IRA are treated extremely differently, like very differently. Like an IRA could be subject, if these things apply, could be subject to an enormous tax upon your exit, and that's a phantom tax. You could end up getting taxed on it twice. So, without going into details here, this is a really important area. If you are leaving the US, if you're on a green card, or if you're a citizen who's thinking about giving up your citizenship, you must engage in tax planning with a professional cross-border tax advisor who can help you extricate yourself the best way possible. I cannot stress that enough. That's the landmine, though. There are opportunities. So James alluded to it before. If you're going back to the UK, where presumably the tax rates for you is going to be higher, that might be an opportunity to investigate a Roth. So I focus on the landmines because they are the most damaging and the scariest, but the flip side to that coin is there are opportunities. If you're engaged in planning with a great firm or firms, you'll have opportunity to avoid the landmines and take advantage of the opportunities. That's a great place to be. It's worth its weight in gold. And if you do have accounts left in the US and you're in another country, let's say the UK, you will probably be subject to income tax in your home country. They'll have first dibs on it. You may also have withholding issues in the US, and you might have to enter into a little dance to get that money back. Again, just something to be aware of. Might be unavoidable. That's it. Anything to add, anyone?
Just can I ask one question? Because and you haven't spoke about it actually. Is the if you're a Brit moving to the US, you've got private pensions. We're talking about forgetting them, but of course I'll let you explain them much more eloquently than myself. Is international SIPs and what you can do with those. But equally, is there a equivalent in the US whereby it allows you to invest in British currency like an international SIP?
Maybe Interactive Brokers. Maybe we're so I'm not. I don't know if you'd be able to withdraw it in pounds, but you might. Interactive Brokers might have the facility to invest in pounds.
Right.
Yeah, I can see if you're in the UK and you got a substantial amount of money in an IRA. And you live in pounds, I can see the benefit in that. You might then have to worry about dancing between pounds and dollars to get it out. Also, I wonder you might be restricted to direct stocks because British pound investments, collectives are going to be PFICs, passive foreign investment companies. That's a topic for another. That's coming up, folks. Hold on to your seats. That's a wild one. But I'm not sure if PFICs are an allowable investment in a US retirement account.
Wow, I would have never seen that. That brings to mind too, and this will be a future topic in the series, but there's something called UK reporting funds that if you do head back to the UK, there are ways to mitigate maybe the most pressing sort of UK penalized taxes by investing in something called UK reporting funds in your US accounts, which we do for our clients.
This is brokerage accounts, all right? This is not. We don't need to worry about this for retirement accounts. I don't think. Again, not a tax advisor, but I think non-reporting funds are okay in an IRA, but absolutely for a brokerage. Mm-hmm. Yeah, if you're a US citizen in the UK, you got to be careful what you hold in your brokerage. You got to avoid PFICs in the UK, and you got to avoid non-reporting funds in the US. You got to tightrope to all. It's doable. Just right before we wrap up here, let's. Simon's posted a couple of things here. So Simon, if you're still listening, sorry we took so long to get here. Brits got their vote back as of January the 1st this year. Well, I need to know about that. It's kind of concerning if I don't. But I'm going to look into that because I'm very interested. But he's also asked, with Labour ditching the non-domicile status, how will this and other changes they may do impact if I return to the UK? Well, look, impossible to answer this question because we can't, what changes? There's no end to the amount of changes they can make, right? There are a couple that are. I know everyone's very up in arms about the non-domicile status, and we're focused on the lifetime allowance regime for UK pensions. That could come back, which would be a huge shame in my opinion. But Simon, we can't. Sorry, I'm talking about Simon Gard. It's the person I won't say his name, but Simon who posted the comment. We can't talk on specific circumstances, obviously. And I'm sure Simon Misiewicz might have more to say on this, but it's the fact that you say return to the UK suggests to me you're a British expatriate in America. So if you return to the UK, you're returning as a Brit. Therefore, I think you will automatically be domiciled in the UK. Therefore, I don't think the non-dom regime is even an option for you. I think, Simon, is that right?
I agree totally. What Labour are trying to do is stop, as for example, American citizens who are not British going to the United Kingdom and then leaving their money in the United States. So what Labour are trying to say is you will be taxed on your worldwide income just like the United States.
Is Rishi's wife quaking in her boots?
Yeah,
he's a non-dom.
I think that's a pure attack on Rishi's wife. Really, I think that's a very political point.
Yeah, I think as I understand it, and I'm not an expert on the non-dom regime, but it's generally believed to be quite beneficial for the UK, right? Because it brings. Or am I could be way off base here.
It is because people will go to the United Kingdom to buy a property, to buy goods and services in the UK, and they will leave their wealth in their countries. So it's very advantageous if Labour bring that in. I'm sure that will put off a lot of wealthy individuals.
Simon, I'm obviously keeping an eye on the UK from over here, and I'm sensing a rising hysteria amongst a lot of folk about if Labour get in.
Panic, I think.
Yeah. Warranted? Unfair?
Who's to say? I mean, we have to say that the Conservative parties, let's not make this too political, but from a tax angle, how many faux pas have the Conservatives made? Where do they fit into the whole wealthy protection perspective? Because they've just done so many damaging things, whether it's to messing up corporation tax. We'll reduce it. No, we won't. The attack of landlords, so the wealthy individuals who own property. Before long, I don't think you could almost tell the difference between Labour and Conservative. Sometimes it's a very, very thin line between the two parties right now.
No, Labour are going to get in, aren't they? It seems so. Changes are coming.
Sure.
Everything's calm over here in the States. I don't know what you guys are talking
about. Right. Very good. On that note, let's call it a day. We'll be back next month and we will be talking about non-US and non-UK retirement accounts. So when you've worked in another jurisdiction, which really, frankly, is a conversation about tax treaties, which I'm very excited for. So thank you, everyone. We will see you next month.
Bye-bye.
Take care.